Sir, there's a GC right there, Cliff.
Go.
It's piers. We got concrete piers and wood piers.
Yes, sir.
Checklist. Let's check out the checklist. We
Yes,
got it for everything we need.
Yes, sir.
Right, you forget some things sometimes. So this is going to outline, make sure you hit every single thing. What's the foundation, plumbing, electric, painting, flooring, everything. So you don't miss anything.
Okay.
You want to make sure you get all your checks.
Okay. Y'all want to introduce you guys to Cliff Hunter. Cliff is a world-renowned flipper. He actually flips. He's also a GC as well. He's a good contractor. When it comes to all of our renovations, all over the nation, you'll talk to this guy right here. What's good, baby? It's your boy Dale. I'm back in the saddle again. Our motto is to buy, build. We already bought it already, so we already own it, free and clear. Refinance to long-term debt, cash flow. That is the motto. Cliff, man, is that a pretty strong motto, man? What do you think?
Man, the model is strong. Like, you're getting each piece of the invest, right?
What it do, baby? It's your partners Dale and Cliff back in the saddle again for another edition of Real Estate Friday training. Guys, man, it has been a week full of ups and downs, but it's been a week where we got to the end. Cliff, baby, how you doing, big time? You doing all right, baby?
Man, doing good. You know, busy week, but busy is good, you know. So can't complain, man. So things going well.
Good stuff. Same thing we're here, man. Did we get the bag? Did we get the bag?
Oh yeah, man. Got the bag this week, man. Looking good. So
Good stuff.
blessed, man.
Yeah, we got the bag too on my end too, man. You know how we do it every single week, y'all, man. If y'all could, guys, if you like what we're hearing, man, share. Subscribe to the channel, guys, man. This is going to be a really good one because some news came out with two big companies, one in the retail space and one in the banking space, guys. And this is going to be cool. And also, we're going to talk about, man, the President Biden's chief economist, his point of view when it comes to government debt. It's going to shock you guys. But guys, man, this one came out before, guys. Before I do that, guys, Cliff, tell everybody, man, what's going on with the market, current market analysis, what's going on with the market, man. Talk to people. What's going down, big dog?
Man, I'm starting to see I think I'm starting to see is a slight uptick, you know, from last week. Nothing crazy. Numbers are still pretty much the same. But I do start to see some acceptance of the interest rates. I think people are starting to see that they're not coming down.
Told you.
Yeah. So we're starting to see some sales. Like I've seen, you know, days on market is down slightly. Now we are in this time of year where it's buying season. So you might see some differences there. You might see some changes there. But so I'm seeing a little bit lower days on market. So houses aren't sitting.
Yeah.
But basically same as last week, you know. There's not much inventory. A lot of people aren't putting their house on the market, so there's only so many options.
Correct. I see the kind of the same thing, guys. I think it's going to slow down even more because I think that the rates are going to go up 8% plus. Remember, the Fed started off with 6 cuts, then went to 4, then 2, now 0. And we talked about last week, Bank of America are planning for no rate cuts until March of 2025, and they anticipate a rate hike, not a cut. This came from Bank of America, okay? Not theory. These are actually, they're planning for that, guys. I think that's going to be no cut at all. I'm not surprised at all what's going on. That doesn't mean that we're not feeling it. I'm just not surprised about it at all, Cliff, man. So I've been saying it for a long period of time. I'm like, man, I don't see how they're going to cut the rates at all because Congress and the executive branch will not stop printing. And when the Fed and the Congress do not shake hands together, one is going to be affected. And so with the excess in printing, the Fed has to respond and rate hike up. It's coming back, guys. It's going up. You're going to continue to see the spin, and the spin. Again, you will know the economy by its fruit. Don't be surprised at what's going on. It's I expected it. You agree, Cliff?
Yeah, I mean, I think you were right. You had called it a while back when you said you thought that possibly, and as you're saying now, rates might go up. I don't know if they're going to go necessarily up, but they're going to stay where they at. And I don't think we may not see a cut for a while.
Mhm.
So it looks like, man, we stuck at these high interest rates for the foreseeable future, bro.
I told y'all, man, I don't want to be the bearer of bad news, but I'm not surprised about it at all. I expected this to actually happen. It's just simple fiscal stewardship economics. It's real simple. It ain't hard. But guys, man, some news came out, guys. Man, there's an economic crisis alert, guys. Capital One is shutting down credit cards. Uh-oh. Also, number two, the recession is now hitting Starbucks as stagflation looms. We're gonna dive into both of these topics. Well, I actually got a question about this when we first announced this was going to be the topic of today's Real Estate Live training today, and I said we go right into it. But here we go, guys. Let's dive right into Capital One. Let's see what's really going on real quickly and see why they are shutting down cards. Okay, we don't know the extent of it. We know that they've begun to doing this as well. Now, get this, Cliff. This actually happened back in 2008. The exact same thing. But banks like Wachovia began to shut down lines of credit overnight. This smells that way. You agree?
Mm, wow. Yeah, I mean, the banks are in bad position. They holding on to all them bonds, and
Yeah.
they got no value.
I told you. I told you the value of those bonds are worthless right now. So if they were to cut those bonds, that would wound them even more. So they're going to have to burn all this excess cash out. And how do they begin doing that? Well, the banks have to say, okay, we gotta cut off some lines of credit because it's starting to make our balance sheets look really suspect. So don't
Mm.
be surprised. Here we go. Let's dive this real quickly. Here we go.
Credit card defaults are skyrocketing across America, something that suggests we could be seeing the beginning stages of what we saw happen in 2008 happen right now. And in
Did I say that, Cliff? Did I say that? I said it. I said 2008. This actually happened. A friend of mine actually had $1 billion line of credit, and they shut it down. Wachovia did this
Yeah.
in 2008.
Yep. Yep. The banks
Man,
they will just shut. That's how easy it is. If you have lines of credit, that's what they will do.
they just shut it down. They will shut it down.
Hmm.
Let's keep going, guys. So the reason for the shutting down is because of the defaults. Because again, people manufacture pay raises by borrowing more on their credit cards, and they have very little in savings. That's what's actually happening, guys. All right, here we go. Let's dive into this real quickly. Here we go.
And in particular, it's US consumers on lower incomes that are facing the biggest loan stress. With
Told ya.
Austin Goolsbee, president of the Chicago Federal Reserve, saying that consumer delinquencies were one of the most concerning economic data points at this moment, particularly for a credit card company like Capital One. Capital One is the fourth biggest credit card issuer in America, and they just reported an astronomical 5.9% charge-off rate on their credit cards, which is
Oh, a 5.90% charge off rate on their credit cards, Cliff. That's scary, man.
Mm.
5.90% charge offs, which means they shut them boys down and they say it's a loss.
Wow.
That's wow. Yeah, let's keep going, guys. Let's keep going. Hold on.
which is the highest charge-off rate that we have seen since the 2008 to 2011 financial crash. In fact, this charge-off rate's gone up by more than 230% over the last 2 years in relative terms. And when a bank or card issuer does a charge-off, it means that they're shutting down the account of the person who failed to pay the bills. And so the fact that Capital One, the fourth biggest card issuer in America, is reporting such a big surge in charge-offs is a major concern for the US economy right now. It suggests that consumers are starting to crack. After 3+ years of inflation and crazy spending, they can no longer do it anymore. And so,
Cliff, does all that make fiscal sense to you?
I mean, the banks they got to curtail their risk.
Yes. Yes. We got a question on YouTube. Would my little credit card be shut down? I don't know. I do not know. It depends on it depends on how much revenue your credit card is generating for Capital One. I do not know. All I know is that they are shutting down those cards, and the card defaults are up 230%. That is ridiculous. That's scary, guys. And it was because of spending and inflation. Hello. That's crazy town, Cliff. My God. She said, I have Capital One. I know a lot of people have Capital One. I would be okay with it. I wouldn't be so concerned about certain credit cards as well, as long as you're on time. Remember what he's saying is he was saying that the reason why that was actually happening was because of cards getting shut down. It was because of defaults on credit cards, not on good performing credit cards, defaults. Would that be right, Cliff?
Right. Yep. The banks, when they start to see defaults come in, then they have to start constraining their credit lines, and in order to help the balance sheet, make it look right, make sure the cash flow is strong. I doubt if you're in good standing.
Yeah.
You should be. Usually it's the larger lines they're going to start cutting first. But stay tuned. You never know.
Stay tuned, guys. Stay tuned, man. Hey, now it's not the time to panic. Okay. It's important for you to know what's going on currently right now. That's why every single Friday we go over the current market analysis. I know that's a bit redundant, but we do that so you know exactly what's going on every single week. Because Cliff, does the market change every week most of the time?
Oh yeah.
Every week. You can't know where you're going if you don't know where you are currently. It's real simple. Now, guys, here's another issue, guys. This comes from the CEO of Starbucks. The recession, let me say it again for the folk in the back row. The recession just hit Starbucks. The CEO warns no one is buying lattes anymore. Guys, this is Starbucks. Cliff, is this pretty big, man, in your opinion?
Yeah, it's. I mean, what don't they have an index called the latte index?
They do.
Something like that, where they could see how the economy is going just based off lattes, and because it's a very small item that you can track for people having a little bit extra money to get an extra coffee. Man, if Starbucks can't sell a cup of coffee now, to me, $7.50 for a cup of coffee is too much.
Yeah.
But if he's saying that they're starting to see slow sales, I mean, to be honest with you, me and Dale, we went over this a couple weeks ago when we saw the dollar store can't make a profit. That's the big. They said that we going under. The 99-cent store is going under. That's this is stuff I ain't never seen before. I thought Dollar General was probably the most stable business you could find.
Yes. And we have another one that says, it says we have a comment on YouTube. It says, interesting that Dunkin' isn't having that problem yet. Yeah, Dunkin' is not, because Dunkin' Donuts, their main business is not coffee. It's donuts. And I would say coffee is just a condiment next to the main course of donuts. It's kind of like Krispy Kreme. Krispy Kreme and Dunkin' Donuts are pretty big competitors concerning that. But let's see exactly what the CEO of Starbucks said about this, guys. Here we go.
The stock price of Starbucks is collapsing due to some big issues they're having at the corporate level. Most notably, people have stopped coming to Starbucks, with the
Wow.
company posting their first sales drop since 2020. Transactions declined in every region, with Starbucks reporting what's perhaps the worst set of results of any large company so far in this earnings season. And the reason that's happening is because there is a big issue going on with the US consumer, everyone. Consumers in America are finally starting to break. And what do when they start to break? Well, they don't buy the $7 latte at Starbucks.
no.
With Starbucks CEO Laxman Narasimhan stating in their most recent earnings call that we as Starbucks continue to feel the impact of a more cautious consumer, as well as a deteriorating economic outlook that has weighed on customer traffic, an impact felt broadly across the industry. And those are some ominous.
Now, Cliff, man, real quickly, man, whenever things get tight for any consumer, even for us yourself, we tend to look at what I call the fat to cut out to begin to say, okay, wait a minute. We're spending how much money at Starbucks? How much money out to eat? We gotta stop doing this, guys, because it's kind of tight. Would that be kind of accurate, Cliff?
100%. I mean, everything's just too expensive. Inflation. This is and me and Dale. We talked about this. You can go back and look.
You can now.
Inflation is horrible, and we tried. We tried to warn everybody. We tried to tell y'all how big of a problem it is. How there's nothing else like it, and unfortunately, it will not stop. This inflation is our only way out. We're trying to slow it down, but we're just going to have slow inflation for a long time. I think if you go look at it, in the last 4 years, we printed 40% of all the money in existence. How long to that breaks even, Dale?
Man,
10 years, 20 years?
Easy, man. It's y'all. It is, man. That's why I kept saying that they're not going to cut the rates, because it didn't make any sense. They could not, because of all the excess spending. 40% of this nation's entire currency in its entire existence as a country, right, was printed in the last 48 months.
Crazy.
40%. And there's no sign of them stopping, because they can't. Guys, you understand that Social Security right now? Cliff, let me ask you a question. How do they pay Social Security? Do they pay it through tax revenue or just printing the money?
It should be tax revenue.
Hell no, they just print the money. There's no money there. It's gone. Medicare, gone. Social Security, all entitlements, bankrupt. That's why they're saying by 2030, right? Or 2035, really, I'm saying 2030, there will be no more Social Security. They have screwed you.
They're going to raise the age.
That's just to buy time. Yep. And again, more spending.
They're going to move it to 70, probably about 70. That France had to do this as well. And they had riots in France when they did it.
Yes, they did. Again, BS. It's bullshit. They're going to spend first. And then what they're going to do is they're going to say, we ain't got no more money. They screwed you over.
But this is why but people don't understand. A lot of times people aren't understanding the economics, because they just hear nice things like, we could spend money on this. We hear about grants, or we're funding this program. You got to understand, we're broke. So they're spending your money we don't have to go buy that stuff. And you're thinking to yourself, yeah, the rich will pay it, or X, Y, and Z will pay it. No, you will pay it, because that latte you gonna buy is gonna be $1 more.
Correct.
That chicken you gonna buy is gonna be $1 more. So you're gonna pay that tax one way or another, right? They're just lying to you by saying that they're gonna take somebody else's money to pay for it. You're gonna pay for it through inflation. That's how it's called a hidden tax.
Notice how President Biden is actually saying, if he's reelected, he's going to raise the taxes. That will, I think it's up to, 46%. That means in 5 states, I think it was New York, California, Illinois, New Jersey, and one more. I forgot the last one was that the state tax will go over 50%.
Yep. Mm-hmm.
50%. Again, the government doesn't make any goods or services. How do they make money? They tax your ass. And they can tax you in 2 different ways. A legitimate taxes, or they just continue to print. Either way they got you. That's why me and Cliff like buying tangible assets. Why? That is the defense against that prescription that I just told you that the government does. It's extremely simple. Am I right, Cliff?
Yeah. Any limited good, gold, silver, real estate, in some cases stock, right? But anything that is a limited good is your defense against them printing money, because they're going to. When they say, oh well, we want to do this program or this program, as long as you hear that, think print. And if they're gonna do that, then the rich are gonna get richer, because what really happens is when they print money, prices go up.
Every time.
So do asset prices.
Exactly.
Price of the business went up. The price of the stock went up. Why do you think this year to date, the S&P is up 10%? Directly correlated to the amount of money they're printing. That's why you see asset prices like the stock market go up during inflation. So there's when they say, "Oh, the market's doing great. Just look at the stock market." That's actually a bad sign when you see high returns, 10%. Dale, in how long has it been? 5 months, 10%. So we're going to have 20% yield in the S&P in 1 year. That's not healthy.
Trash, garbage, horrible, trash, horrid, boo boo, dumbassness. Yeah, I said it. It is. This doesn't make no damn sense, y'all. It don't make no sense. You have Capital One shutting off credit cards because of defaults. It's up 230%. 5.9% of their credit cards they have charged off. Let's say 6%. And then you have the CEO of the most popular coffee brand and retail store in America saying, ain't nobody buying no lattes no more. Why? Because it's too damn expensive. Oh, my bad. It's too expensive, guys. It don't make no sense.
It's wild.
Wow, bro. It's wild. Now you may say, well, Dale, how does this make any sense? I'm glad you asked that question, y'all. I'm glad you asked the question. But before I go there, guys, it's Cliff, man. But before we go to the next section, man, comment on this real quickly, man. When it comes to Starbucks, how popular was in the corporate world? Because you came from the corporate world and then you got into real estate, right? How popular was Starbucks for everybody to go to throughout the day?
Oh man, that's the only place people would really go. For a coffee. If we had a meeting, we already know there's gonna be a run to the coffee shop, and it's gonna be Starbucks.
It's man, Cliff, man. This could be a little bit scary, man. I for a lot of people. I just, man, it's time for a counter move. It really is. Most individuals that I talk to today, they're really concerned about the economy, specifically the volatility of it. Now, the area of their concerns really centers around the variable of inflation. And inflation right now is really outpacing people's wages, number one. And number two, it's beginning to affect their 401k and IRAs because their retirement accounts are connected or intertwined with the stock market. Over the years, I've been fairly successful in real estate investing. Currently, I own about $35 million worth of real estate under management. And also my partner and I have been able to build our private equity and venture capital firm to about $1.2 billion worth of assets under management. Now, this success has taken place in up or down economies. Now, whenever there's volatility in the market, opportunities begin to show up. There are 3 investment strategies that, if implemented the correct way, any investor can go from 0 to 6 figures in the next 6 to 12 months. Click on the link below or swipe up and let's talk through these strategies. Now, Cliff, man, let's dive into, man, a question I get all the time is how does the government make these type of decisions just to print, right? And let's dive into President Biden's chief economist's point of view. Y'all, I want y'all to listen to this. I want y'all to listen to this. Genius, y'all. Oh my God. I mean, gonna blow your mind. Just listen intently of what this man says, y'all. Just listen, and then what me and Clifford do is we will respond. All right. This is his current chief economist. He's making decisions that affect your life fiscally. Here we go. Let's see what he says. Here we go.
It isn't that long, but it's worth your time. And I want you to understand this is the president's main economic advisor who is going to dictate your economic life for the next 4.5 years should we lose. He doesn't even understand that a government bond is not the government lending anyone money. It's taking people's money. He has no idea. Watch.
The government even borrow?
Well, again, some of this stuff gets, some of the language that some of the language and concepts are just confusing. I mean, the government definitely prints money, and it definitely lends that money, which is why the government definitely prints money, and then it lends that money by selling bonds. Is that what they do? They sell bonds. Yeah, they sell bonds, right? Because they sell bonds and people buy the bonds and lend them the money. Yeah, so a lot of times, at least to my ear with MMT, the language and the concepts can be kind of unnecessarily confusing, but there is no question that the government prints money and then it uses that money to,
wow.
Yeah, I guess I can't really talk. I don't get it. I don't know what they're talking about. Like, because it's like the government clearly prints money. It does it all the time, and it clearly borrows. Otherwise, we wouldn't be having this debt and deficit conversation. So I don't think there's anything confusing there.
He's the chief economic advisor for the United States of America.
The fuck? Let that, I gotta get a little vocal. Let that shit sink in. That is the chief economist for the sitting president of these United States, who's making monetary policy that affects your life. This MFer doesn't know how the fucking money works. But he is a chief economist. Get the fuck out of here.
Man, if you just tell people what they want to hear, you too can become a chief economist.
Woo! Cliff, my dude said, "Is that how it works again?" I don't know. It's all just confusing. It's your damn job to know what this means, man.
Dale, what? Oh, it's okay. We can go to our other economic geniuses. I don't know. Maybe somebody who says transitory.
Brilliant there. Transitory, the other one that changed how they calculated the inflation rate. It was every 24 months. Now it's every 12 months.
Right.
You know what I'm talking about? Or it's that other economist that says that our unemployment rate is really 3.9%. But if you look at the damn numbers, There's 1 million jobs out there that went to un-American born workers, outpacing American born workers by 1 million jobs. And those jobs are part-time jobs. You see all that brilliance there? All that brilliance. This is just, I mean, wow. Clip, I don't even know what to say. I don't know what to say.
They just gaslighting. They gaslight. Number one, they incompetent, and then on top of that, if they don't like the information, they just change the definition. That's it. I'll just change what it means. You know, we're not broke, we're rich. I just changed what broke and rich mean. That's all I did.
My man said, "Is that how it works again?" Hell, I don't know. It's a bit confusing, you know. Notice you said real sly, MMT. You hear that, Cliff?
Right. Yep.
Modern monetary theory. Again, this is the chief economist for these United States of America. He is saying that we're operating by modern monetary theory. If you know what that means, guys, we talked about it. We talked about that and in several different lives. Go listen to the previous ones. You need to know what that means because it's not for your benefit. It's for the government's benefit. They believe, as Cliff said, that they can inflate the debt away by continuously to print. Am I right, Cliff?
Exactly. They think that printing doesn't cause inflation. That's what they believe.
Cliff said that slavery a little bit slower. Some folk didn't hear you. So say it again.
They believe printing money does not cause inflation.
The fuck out of here. These are the Ivy League people.
Mm-hmm.
Harvard, Penn, Brown, Columbia. Y'all, we're in some trouble. we're in some trouble. We're in some trouble. We're in some trouble. All right, y'all, man. What's the real estate counter move, guys? Whew, that right there, I'd laugh a little bit on that one, Cliff. Man, guys, me and Cliff gonna say this 100% of the time. I think rental property investing is the best way to go. The reason why is because you have a tangible, hard asset to guard you from the incompetency that we just heard just now from the chief economist of the U.S. I don't want to hear about no more titles. No more titles. Have you created a business before? Have you hired somebody? Have you grown a business? Have you scaled it? No, get the hell out. Sorry, holla at you. No. Playtime is over. These dudes are stupid. Dumb. Buffoonish. If you agree, man, when they come to rental properties, man, I'm sorry.
Oh, yeah. Man, rental properties it's got everything. Wealth preservation, cash flow, tax deductions, consistency. I mean, it's probably the best asset thing that there is. I mean, it covers everything. I mean, especially if you're in a high demand area, man, you'd be amazed what a handful of rental properties that can do for you. 1,500, 2,000, 3,000 cash flow every month. Even something small like that, you can have a lot that can do a lot for you. And and if you do it right, and if you follow what we say, we can teach you the strategies in order to do it safely and effectively and get long-term cash flow plus appreciation.
I'm glad Cliff said, if you follow what we say. The reason why, guys, is me and Cliff are always asked all the time is, can you guys train us? Well, yes, we can. And it's on-demand training, right? This is called the Cash Flow Club. It's $99, right? It's on-demand training because our time may not match your time, right? So if you can get us on demand, you're good to go. You can scan on this QR code on the screen, or you can click on the link below in the description. It's right there, guys. You get me and Cliff 24/7. I'm actually adding a new course this weekend. We add a new course of how to structure and formulate your company in your current state. I'm going to use Texas. I use Texas as the example, but it's virtually the exact same thing with some differences and nuances here and there. But it's very simple to do because most investors buy their real estate in their name, which I'm like, what the hell? That made no sense, Cliff. Would you agree or you disagree?
Nah, you definitely. I've seen a lot of people start off. I would say the majority of people who become real estate investors accidentally do it. They buy a property, they need to move, they got to move out the house for some reason, and they just rent their own house. And then what happens is they realize the value of a rental.
Yeah.
They go do another one, and they do it the same way. They buy it in their name. They go through a conventional mortgage.
Yes.
And that's the mistake, because you need to treat it like a business.
You do. Now, Cliff, let's walk through an example, guys. And next week, we're going to show you guys a before and after of a property that we acquired in Jackson, Mississippi. And we also begin on another one as well. Our goal is to buy the entire city of Jackson, and we're going to do it.
And how much did we buy that property for?
$15,000.
$15,000.
Cliff is a 4-bedroom, 2-bathroom house, right?
Right.
1,600 square feet, right? 1,600 square feet. Pretty nice size house.
Right.
It's good size front and backyard, right?
Right. Yep.
Okay, gotcha. Okay, gotcha. We invested about $38,000 into the renovation. Am I right?
Right.
So hold on, Cliff. Let's. I want people to kind of see the numbers, because they would think we bullshitting, but we're not. Here we go. No problem with it all, y'all. Let's walk through this now. This is how you walk through a deal, guys. Okay, real simple. All right, real simple. I'm going to begin doing this a little bit more often. Real simple, guys. All right, here's how you walk through a deal. Boom. I'm going to get rid of this real quickly here. Give me 1 sec here. Boom. Bye. You got me and Cliff here. Now watch this, guys. I want y'all to see this. Now, Cliff, how much did we buy the property for?
15,000.
Right? Boom. 15. Come on now. $15,000. Right? Boom. 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 Right? And how much did we put in the renovation wise?
$38K.
$38,000. All right. So we're all in, Cliff, at $53,000, right?
Mm-hmm.
Okay, remember $53,000. We put like retail grade type of renovation in it. So the creme de la creme. Am I right?
Right.
Okay. So based on that, because you're a licensed appraiser, you would know this. What would be the value, the ARV on that, now that we've increased the value?
We're looking for around 110.
So $110,000, right?
Mm-hmm.
Now, how much will the bank give to us?
About 80%.
80%? Okay, let's go ahead and use 75%. Let's go ahead.
We're trying to cash out. I got you.
Yeah. Let's go ahead and just be real conservative. 75%, right? Here we go. That's $82,500, right?
Right.
Cliff, how much were we into this thing?
53.
$53,000. Okay, let's see what's going on here, Cliff. I'm good with math. What was the profit, Cliff?
Man, we're looking at $29,000.
Now, Cliff, is that money tax, big dog?
No, that's tax free.
Why is it tax free?
You do not pay taxes on loans. This is cash out loan. It's tax free.
Now, Cliff, that's one deal. Let's go to the other one real fast, okay? Here we go. The one we started on. She was starting on the renovation today. That one right there. So we made about 30 racks on this. 30 racks tax free. Thank God, good. All right, here we go. Now we bought the other property for $20,000, right?
Right.
$20,000. I think we put about what is it, 45 or 50,000 into this one?
Oh, that one. I think we're only putting 30.
Oh no,
35.
No, we actually in that thing, man, because it's a little bigger. I said about 45,000.
Okay, 45.
About 45. Let's go and guess how 45,000. We know the number, guys, but it's not in front of us. So we're all in at how much, Cliff?
65.
All right, cool. The ARV for that one was $140,000, right?
Right. Yeah. Yep.
My God, look at this. Okay, again, 140,000 times, again, conservative, 75%, Cliff. That's 105,000, right?
Mm-hmm.
Now, Cliff, how much were we into that thing, bro?
We were like 85.
No. How much were we in it all in? Was it 20 plus 45? That's 65,000.
65, right? Yeah. You're right.
65,000. Here we go. Boom. Now watch this, guys. How much profit did we make, Cliff?
40 racks.
Is it taxed?
Tax free.
Wow, here's the brilliant thing about it. Cliff, man, What are the rental rates in the area?
Oh, I think that one we're looking at close to $1,500.
$1,500. Okay, but hold on before we go to the rental rate. So we made $40,000 on this one, tax free, plus $29,500 on this one. Right? This is just 2 deals. Cliff, how much have you made, bro?
70 racks.
70 racks, tax free, right?
Tax free.
Now, Cliff, man, how much, man? How much when it comes to these 2 properties, big dog? Because we have 2 of them. And really, the first one is bigger. No, the first one is a little smaller than the second one, right?
Right.
It's
Yep.
okay, no problem. How much do we anticipate that we will net per month on per both these properties per property?
I think interest rates are kind of high, so maybe 200, 250.
Let's go say let's go to say 250, 250, right? Times 2 is what? That's $500, right?
Yep.
That's cash flow per month, right?
Yep.
That's just 2 deals, guys. Now, Cliff, we put something in together right now that we're going to actually begin to do 3 to 4 a month, right? Cliff, let's do this again, big dog. So if we're doing $250 per month per property, right? And let's say we do 3 per month, right? Just keep it easy. 3. That's right. Here we go. That's $750 a month, right? That times 12, that ain't bad. That's about $9,000 passive a month, right?
That's right. That's passive. That's having a management company in place, just letting cash flow come in.
But Cliff, man, we just made. I'm gonna use the small one, $29,500 on the other one, right? Cliff, we do this 3 times a month. How much is that per month?
Yeah, looking at 89,000.
That right there, Cliff, times 12. Remember, it's 3 per month, guys. What's that, Cliff? How much are we making on an annual basis?
$1 million.
Is it taxed?
Tax free.
Holler at your partners. Not bad, is it?
No. It's a good strategy.
And Cliff, I think we were actually wrong because it's $750 a month, but it compounds per month. So we're not making $9,000 annually. It's actually a lot more than that. Does that make sense, Cliff?
Yeah, and then you also have to remember that's what 36 houses, right?
Correct.
Now, if we raise rent,
So
let's say $40,
36
not much,
times 50. Hold on, here we go. That's $9,000 a month. That times 12. My bad. I was wrong on my numbers. Thank you, Lord. That's $108,000 annually in cash flow. Now, Cliff, you were saying if we raise it up, how much, Cliff?
If we have $33, or I was at 33 rentals,
36 rentals,
or 36, right? And you raise rent $40.
So we had 250, right? Plus 40, right? Boom. That's 290, right? That times 36, right? Am I right, Cliff? That is $10,440 per month.
You made $1,400 more a month just through doing zero work. You just raised rent.
And on an annual basis, guys, that is $125,000. So we were at 108, Cliff. Now we at $125,000. That is what? That is 108. It's 10,000. Yeah, that's $17,000 raise annually.
Yep. Every year, because if you raise rent $40 a year, you're getting a $14,000 or $17,000 raise annually, and that's not even adding new properties. That's your existing portfolio.
It's not theory, guys. This is what we do every day. I hope we talked to something a little bit, guys. So this is not to brag. It's to say, guys, we're doing this with single-family residences. We're also working on a 58-acre land that we're actually looking at acquiring. We're also working on 18 properties that we're building. That's going well for us as well also. So we're in new construction. We're in land development and new construction. Well, I also get a text messages from our partner up in Michigan, our boy Harvey. We got we had a 1,046 unit apartment complex that we may buy for a nice discount. So we're in several different areas, guys, and so I'm thinking about guys starting a fund for individuals because I get DMs all the time, Cliff, asking if they could join in us when it comes to real estate investing. So I said, and also private equity investing. And I said, let me see about it. And I think I may open up a fund for people to actually do and pay them a nice little annual return, which would be good. That money can be tied to a tangible asset, which is insured by insurance, so that you actually have a proper gauge against modern monetary theory, which is printing the debt away, because that's actually happening.
Right, exactly. Yeah, and I think that's smart. I've had an investor come to me as well, and the structure that I had explained to him was, we're long term. So I always make sure they understand if you invest in what we're doing is long term. Typically, what we like to look for is, when you invest, we're looking at getting a decent return for 5 years. At the end of 5 years, you can sell your position, and we'll try to find another investor who could buy you out.
Correct.
If not, if you want to if everything's going good and you've been cash flowing, you can reset for another 5 years. And we just
Correct.
do it every 5 years where you have an opportunity to buy out your position.
Correct. It's simple, guys. This is a long-term game. Short-term is gone.
Yeah, and we'll talk later about how you can actually, and actually I'll explain it to you guys too, of an interesting way of how you can position it. And so what I've learned is what you do is, let's say you're doing one of our rental properties, and we're looking for a $10,000 investment as an example that we're going to give you a return. Let's say we're doing a 10% return. You give us 10,000, we're going to give you $1,000 a year in return. When we set up the deal, we're actually going to have the property in our LLC.
Correct.
And we're going to have a second LLC created that owns a equity position or a cash flow position in ours, and you buy that LLC. That gives you ownership into the dividend, and it gives you ownership into any other equity position that we have.
Correct.
And so anytime you want to get rid of it, you just sell that LLC to anybody else you like.
Correct. That is spot on, guys. There's so many ways you can do this. So we may roll out the fund for individuals that are looking for something to place the money into. We may even do some type of training on that, VIP training on that, for those that actually have some questions about it. And we'll bring on our attorney if we need to. I see a CF, our accountant. They can talk to you about how it can be structured, all that, guys. And I'm only doing this because I was asked to do it. I really don't want to do it, but I know people that they need a lot of help right now. And me and Cliff get bombarded with a lot of messages, DMs, and things of that nature. We're setting up a more robust follow-up mechanism for everybody, so that we can get back with everybody as well as fast as we can. Because as the market change, your education changes at the exact same time. So what we communicate today may be different next week when it comes to strategy because of something new. But the foundations remain the same. Long-term rental investments. Right now, long-term investments are key. And I tell everybody, don't start big like apartment complexes. That's what Grant Cardone does, and which is fine. And he really focuses on Class A type of transactions. And that might mean, Cliff, we want Class C minus, B plus, maybe even B minus ourselves as well, also, or C plus, because of the fact that we want to increase the value. Like one of the properties we're looking at, they have a fire every 3 months. Apartment complex. And we say that's a problem. We like that because while we can come in, diagnose the problem with our construction team, put the property manager in place, go to our bankers, get what we actually need from a financial standpoint, and execute flawlessly.
Yeah, and everybody has their different way. I personally, the reason why I like single family and small 1 to 4, financing is easy and simple.
Correct.
Tenants tend to stay longer. On average, on single family in those homes, they stay 4 years on average, versus with apartment complexes 18 months.
Correct.
You have a turnover. So a lot of
Correct.
turnover versus in a rental single family, you might have, if they renew one tenant, that's 8 years of cash flow
That's correct.
on one tenant. And the last part reason why I like it is acquisition is simpler.
Correct.
You can get bigger discounts, easier discounts
Ton.
at that. And so why not just dominate that level because of all those opportunities and just
Correct.
hammer it home.
Correct. Correct. The only time me and Cliff will entertain an apartment complex of any size is if we can buy it below wholesale.
Yeah.
Our model doesn't change whether depending on the size of the deal. We still want to buy below wholesale because that protects us, our bankers, and potentially even our investing partners. Once we do that, the deeper you buy it, because of the inflationary rate right now, the more protection you give to all of your partners involved in the deal. So the money is made on how you negotiate, not when you sell. And to be honest with you, why would you sell in this economy? Because taxes is going to kick your ass. Kick your ass. It really is. I want my money tied to something tangible, right? That people actually need. And there's only so many apartment complexes or units in the United States. Right now, you actually have the U.S. when it comes to home ownership. It's like 60% home ownership, 40% rental. That's about to flip to where it's going to be 60% rental, 40% home ownership. It's going to flip. And we want to take advantage of that flip. Do you?
Yeah. I think it's a perfect time to start building a rental portfolio. And and exactly like we explained before, if you build it, number one, if you build it correctly, you get a pay raise every year.
Yes.
And then you add more to your portfolio. And the best part is you have a equity position. So if you had to sell your portfolio, you could say, I got 33 houses. You could sell it and you would net, if you're at 30,000 a pop, you're looking at $30,000 times 33 properties. That's basically $1 million on an exit. Even in a quick sale, in a fire sale, you're like, I'll take $500,000.
Correct. So we may do, and I'm probably going to end up doing the fund, and it's going to invest in not only real estate but also private equity as well. Also, again, we've mastered the investment strategy when it comes to real estate. Also, let's go ahead and put another type of protection there, which is what? Private equity investing. I think now it's a proper time to acquire companies, right? Below wholesale. For instance, a good friend of mine, what he's been able to do is he actually acquired Radio Shack. Ty Lopez. He's not a friend of mine. I know of his content. He formed a fund that bought Radio Shack.
That's smart.
Very smart.
Branding. Has a good branding name. He could redo it with that. Yeah, makes sense.
And there's so many small businesses that need to be bought out that were owned by baby boomers. I think now's the time to do two things: buy a bunch of real estate at the right price point, and also buy a lot of businesses that are already functioning. You just step in, put the proper management team in there, and let someone build it, work in the business while you work on the business. That's it. It's not hard.
I think you have to find a niche, maybe. I do like, one area I thought about that it's low overhead, very nice, is pool cleaning. Consistent, strong income. You only have to have a couple of employees, low overhead, have a little business with a truck, right? You might get a couple of trucks. You could expand into an area, but a small business and somebody who wants to exit that. I've been looking at those.
Correct. So, guys, there's a lot of opportunities going on. I know things may be a little tight, right? And to be honest with you, at times we do feel it. We do. But we have a plan to countermove that. Do you? This is the reasoning why we actually have the Cash Flow Club. The Cash Flow Club here is $99, right? If you can get educated, bring your deal. We'll teach you how to structure it, how to negotiate it, how to acquire it, how to renovate it the proper way, and how to exit in the training. And if it makes sense, we'll fund the deal with you. How can you lose? It's real simple.
Yeah, it's amazing, man. You'll get to talk to us, learn a lot of stuff, see what we're doing. I mean, for $99, I really wish this would have existed a while back.
Me as well, man. But I'm kind of glad it did not at all because it forced me to actually think outside of the box. And at
True.
times, I hate it at times, Cliff, because I'm like, man, I wish I had somebody that could teach me as well. But a lot of things that we do, Cliff, we're kind of pioneers in the real estate industry to where we know where to buy, how to structure, how to negotiate, how to formulate power teams, how to locate the right insurance, right? How to build new construction, how to vet the contractors there, because vetting contractors is a skill. Matter of fact, I actually want Cliff to go into detail, not today, but in another live, how to hire the proper contractor. And here's a news flash: when it comes to construction, Cliff, is that industry at all regulated?
No, it definitely is a skill. You have to understand what you're doing, how to select the right people, have backup strategies, and then ultimately get it to the finish line.
Gotcha, man. So there's a lot of things we want to do, guys. We're going to get in that bag a little bit as well, guys. But join the community, join the cash flow club. Got $99. Get educated, right? Invest in yourself. We don't need you. We don't need your money. We want to educate you so that you can begin to generate 6 figures of income, which allows you to retire early if needed, and for you to begin to create generational wealth in that order. Not hard, guys. But guys, man, Cliff, you want to say anything at all, man, before we end today, big dog?
Nah, man, you already know. Same thing. You one deal away. So take advantage. There's a lot of opportunity. Man, just take action. That's the biggest thing.
Take action. Don't get paralyzed by analysis. Don't second guess everything. I'm not saying that you don't begin to think smartly. Do that, but widen the circle, invite in some wise counsel. Trust someone else's advice outside of yours if it makes sense, and you can go a lot further as a team versus being a lone ranger. Would you agree, Cliff?
Yeah. You get the different components. Everybody gets to work together.
Guys, well, man, thank you for your time. Those that want to join the Cash Flow Club, click on the link below, guys, which is fine. At the exact same time, you know how we did every single Friday, man. You know, end every time, guys. Before you leave them while you can, take that damn picture for your mom and them and holler at your partner. God bless you guys. See you next week, guys. Peace.
Bless God, give thanks. Bless God, give thanks. Bless God, give thanks. Big God, big